Your savings account is doing exactly what it's supposed to do. It's just not doing what you think it's doing. Right now, Japan's government just made hundreds of billions in losses disappear overnight, legally, quietly, with a single accounting rule change. And the reason that should stop you cold is not because of Japan. It's because the US is on the same path. The US shows several structural similarities, high debt levels, aging demographics, and persistent deficits that mirror elements of Japan's trajectory. And the playbook they just used? Your government has already read it. By the end of this, you'll understand exactly why the assets most people are told are safe, cash, bonds, dividends, stocks, are the first ones destroyed when this plays out, and what actually holds value when governments start printing their way out of debt they can never repay. This isn't doom, this is mechanics, and once you see it, you can't unsee it. Let's back up because there's a mechanism here you need to understand before we talk about what to do with your money. Japan has been running near zero interest rates for decades. During that period, Japanese banks and insurance companies bought enormous quantities of government bonds at those near zero yields. That seemed fine until yields started rising. When yields rise, existing bond prices fall. A bond that was issued when yields were nearly zero is now worth far less on the open market because you could buy a new bond that pays much more. To illustrate the scale, according to reports, certain Japanese government bonds issued at close to face value are now reportedly trading at around 38 cents on the dollar, a loss of over 60%, because they pay near zero interest in a world where rates have risen. That figure is cited across financial media, but refers to specific long-duration bonds, not the entire JGB market. The principle, however, is not in dispute. What remains debated is not whether long-duration bonds fall when rates rise, but how broadly those losses translate into systemic risk. This is not a new mechanism. It is exactly what destroyed Silicon Valley Bank in March 2023. SVB held long-duration bonds that lost market value as rates rose. When depositors tried to withdraw funds, SVB had to sell those bonds at a loss. The bank collapsed in roughly 48 hours. What Japan is now reportedly dealing with is that same dynamic, but spread across an entire national financial system with losses that analysts have estimated in the range of hundreds of billions to over $1 trillion, though precise figures remain disputed. So what do regulators do when the losses are too large to absorb without triggering a crisis? According to reports, they change the rules. They allow institutions to classify those bonds as held to maturity, meaning the losses don't have to be reported. The bonds stay on the books at face value. The crisis is technically invisible. It's a bit like if your house lost 60% of its value and your bank called to say, don't worry, we're just going to keep it on the books at what you paid. Problem solved. Except this isn't one house. This is an entire national financial system making losses disappear with a rule change. Here's the question worth sitting with. If Japan can make hundreds of billions in losses disappear with an accounting decision, what does that tell you about how every government with an unpayable debt load will eventually respond? We already saw a preview of this in August 2024. Japan raised interest rates by a fraction of a percent, a move so small it barely made headlines. And in the days that followed, Bitcoin dropped roughly 23%. The NASDAQ fell around 10%. The S&P 500 dropped approximately 8%, not because of anything happening inside the US economy, because Japanese money, borrowed cheaply at home and invested in US markets, started flowing back to Japan. Analysts have estimated the total scale of this so-called Japan carry trade at somewhere in the range of $20 trillion, though that figure is contested and difficult to verify precisely. What is not contested is the direction of the flow when it unwinds. That was a warning shot, not the event itself. And here is why the current situation is bigger than August. In August, Japan moved rates slightly and then backed off. What's happening now is structural. The losses are still there. They've just been reclassified. The pressure hasn't been released. It's been hidden, and hidden pressure doesn't disappear. It builds, and Japan is not unique. It is early. The United States is carrying federal debt at roughly 120% of GDP. The federal deficit has exceeded $1 trillion every year for years, and in fiscal year 2024, it came in at approximately $1.8 trillion. The US added more to its debt last year than the entire GDP of most countries. The debt is not shrinking. It is compounding. Now pause for a second. None of this means collapse tomorrow. Debt cycles play out over years, sometimes decades. The danger is not sudden chaos. It's gradual math, the kind that compounds quietly while most people assume everything is normal. Now, governments facing unpayable debt have three theoretical options: default, which no major government with a reserve currency will voluntarily choose. Austerity cuts spending and raise taxes, which is politically catastrophic and almost never sustained. Or inflate, print money, devalue the debt in real terms, pay back dollars that are worth less than the dollars that were borrowed. Historically, when governments face sustained debt pressures, inflation has often been the most politically feasible path, not because it is ideal, but because it spreads the cost gradually across the entire population. Not every country follows the same trajectory, but the historical pattern is difficult to ignore. Just demonstrated how accounting flexibility can be used to stabilize the system during periods of stress, even if it does to eliminate the underlying economic pressure. So what does the playbook actually look like step by step? The government borrows more money by issuing bonds. The central bank buys those bonds by creating new money. In Japan, the Bank of Japan reportedly now holds over 50% of all Japanese government bonds, the endpoint of a process that began with the same temporary measures every government uses. That new money enters the economy through government spending. More money chasing the same quantity of goods produces price increases. That is inflation. And inflation critically reduces the real value of the debt. You borrow dollars worth 100 cents. You repay with dollars worth 70. The debt becomes manageable, not because you paid it off, but because the currency depreciated. Step 6 is the cover. You change the accounting rules, you reclassify the losses, you adjust how inflation is measured, and you keep the public focused elsewhere. This is not a conspiracy, it is arithmetic. It redistributes purchasing power, benefiting some, disadvantaging others. The people who understand this and who own the right assets benefit. The people who don't, who hold cash, who hold bonds, who hold dividend-paying stocks that look safe, may see their purchasing power steadily erode without realizing it. Here is the part that makes this particularly hard for middle-class households. The assets that protect against inflation are not the assets that most financial advice steers ordinary people toward. You are told to hold a diversified portfolio, bonds for stability, cash for emergencies, maybe some dividend stocks for income. These are precisely the assets that erode fastest in inflationary environments. A bond paying 4% when inflation runs at 7% is losing you 3% per year in purchasing power. Cash loses silently every year. A 4% dividend yield looks attractive until inflation is running at 10%, at which point you are falling behind while feeling like you're doing something right. You're getting poorer, not because you did anything wrong, but because you're holding the assets the system told you were safe, and safe in this context means safe for the system, not for you. So what actually holds up? The first category is companies with genuine pricing power. These are businesses that can raise prices when their costs rise and customers will still buy. Think about brands so embedded in daily life that a $100 price increase doesn't change behavior. People budget around them. The metric that identifies these companies consistently is gross margin. Companies with durable pricing power, often reflected in consistently strong margins over time, tend to have the ability to pass higher costs through to customers. Gross margin can be one signal, but brand strength, recurring demand, and competitive positioning matter just as much. These companies protect earnings even when the dollar weakens. The S&P 500 index holds some of them, but it also holds a lot that don't fit this description. The index approach works over long time horizons, but it doesn't distinguish between the companies that thrive in inflationary environments and those that get squeezed by them. The second category has a 5,000-year track record. Gold rose from approximately $35 per ounce in 1971 to approximately $850 by January 1980. That was a period defined by U.S. debt overhang, dollar devaluation, and sustained inflation, the same conditions that are now being built, more slowly and more quietly, into the current system. That move is not a price prediction. It is a historical data point about how gold has behaved when governments inflate debt away. You cannot print gold. You cannot create it with a central bank decision, and global central banks have been buying it at some of the fastest rates in decades, which suggests the people managing sovereign balance sheets understand something about where this is going. Silver tends to move in the same direction as gold, but with significantly larger swings, more volatility, potentially more upside, and considerably more risk. It is not for everyone, but for those who understand what they're holding and why, it has historically amplified the gold trade in inflationary periods. Now, what to actually avoid? Cash and cash equivalents are FDIC insured, which protects nominal value. But in sustained periods of negative real interest rates, purchasing power erodes quietly year after year. That is not safety. That is slow erosion that doesn't show up on a statement. Long-term government bonds are the most dangerous in this environment. If a bond pays 4% and inflation rises to 7% or 10%, the market value of that bond collapses. Nobody wants to own a 4% bond when everything else is more expensive. That is exactly what happened to those Japanese bonds. That is exactly what happened to SVB. Dividend stocks, utilities, and REITs look defensive. But they are valued like bonds based on yield, and when rates rise in response to inflation, their prices fall. The income stays, but the real value of the asset erodes. Speculative growth stocks with no earnings are the most fragile. They are priced on future profits that are discounted at today's interest rates. When rates rise and cheap money disappears, their valuations collapse fastest. Most middle-class portfolios hold some combination of all four of these: cash for the emergency fund, bonds in the 401k, dividend stocks for income, a few growth names for upside. It is the default allocation. And it is almost perfectly inverted for what happens in an inflationary debt cycle. So the question is not whether to panic. The question is whether you understand what you actually own and whether it is positioned for the environment that is being built around you. As the investor Peter Lynch observed, more money has been lost waiting for a crash than in any crash itself. The answer is not to liquidate. The answer is to look honestly at your allocations, to understand which of your holdings have pricing power and which don't. To think about what role, if any, hard assets play in your specific situation, and to make those adjustments methodically, not in response to fear, but in response to understanding. Japan has provided a real-world case study in how these dynamics can unfold. The accounting rules changed. The losses were hidden. The inflation playbook advanced another chapter. The middle class will absorb this quietly in grocery bills, in purchasing power, in retirement accounts that grow in nominal terms while shrinking in real ones. The people who understood the mechanism early will look back on this period as an opportunity. Which side of that you end up on is not a matter of luck. It is a matter of whether you understood what was actually happening. This is not financial advice. Please consult a qualified financial professional before making any investment decisions. Every situation is different and nothing here should be taken as a personalized recommendation. If this broke something open for you, share it with someone who needs to hear it. This is what the wealth we were sold is here for. The money mechanics they should have explained a long time ago, laid out clearly without the noise.